Can everyone hear me okay? Perfect. So good morning, or mid-morning actually. So I'm going to take a very different tack. We've heard nothing but regulators this morning. Right? Nothing wrong with that. Nothing wrong with that. I have a very different perspective though. I'm an investor, so it's the quintessential put your money where your mouth is. So I remember back in 2010, I was giving a presentation at a regulatory event just before Sheila Bair was retiring, and she had made a comment to the press saying that, in her view, the pace of bank failures was going to slow, and everyone was trying to analyze, how does she come up with this? What's her view? And I said, it's prophetic. The FDIC determines when the bank fails, so she's telling you it's going to slow. And the reason that's relevant here is you just heard from state regulators, the FDIC, and the Fed, I would say giving you a lot of information about how they view the world. It's prophetic. So if you're curious as a bank of what the regulatory view is, listen. They're telling you what their concerns are. So I'm taking a different tact. My whole background has been, I've been a commercial banker, so I've been on that side of the fence. I've been an investment banker, a private equity investor. But for a decade and a half now, I've been investing in community banks. I've put about $5.6 billion of capital into around 450 banks in 49 states. Alaska, if you're curious. I'm working on that. But every state but Alaska. And the whole view that I found 15 years ago, and I'm going to give a little perspective tying to some of the things we just talked about, is that banks are a lot more resilient than people give them credit for. So there are still 3 banks operating in America that have been around since the War of 1812. There are over 100 banks that are still in continuous operation since the Civil War. Now, you'll hear from time to time community banks are highly risky, especially after the S&L crisis, right, in this part of the country. Would it shock you that at the worst year of the S&L crisis, 1988, only 1.58% of the banks failed in that year? That was it. From 1940 to 1980, not a quiet period in American history. Anybody want to guess what the worst one-year failure rate was for banks? 0.05% for 40 years. It's not a very volatile industry. Even this crisis, we had about, 465, 470 failures, but that's out of around 8,500 banks at the beginning of this crisis. That's about 5.5% cumulatively that have failed since 2007. That's not a very big number. And so I was intrigued after writing research years ago that uncovered all that, because back in the 1990s when I started looking at banks, the FDIC.gov website was not much more than a business card. There was no database. I had to get all the data. But what we're going to talk about for the next 25 minutes, which is tough for me. I normally do an hour or two. I also teach at Columbia, so forgive me if I tend to want to stray into interesting thoughts, is to talk a bit about what I see as the future. Because as I said at the start, I have my money where my mouth is. Billions of dollars at risk in community banks. And I'm positive. I'm actually pretty excited. So let's talk about why I continue to want to invest. So we're going to do 2 exercises just to kind of bring our minds into the same place, okay? First exercise, I would like everybody in the room to take their arms, cross their arms. Come on. Okay. Put them down. Put them back up. Did anybody switch which arm is on top? Yeah, you always do. It's really strange. But for everybody else, you tend to just follow habit, right? We have ingrained habits, and we do things a very similar way. And there's a great little story that I heard years ago, and I'm just going to read it because I think it proves this point even further, okay? A short story said there was an experiment done. This is from Psychology Today. And it said that there was an experiment with 5 monkeys. It said they started with a cage containing 5 monkeys. Inside the cage, they hung a banana on a string with a set of stairs placed under it. Before long, the monkey went to the stairs and started to climb towards the banana. As soon as he started up the stairs, the psychologist sprayed all the other monkeys with ice-cold water. After a while, another monkey made an attempt to obtain the banana. As soon as his foot touched the stairs, all of the other monkeys were sprayed with ice-cold water. It wasn't long before all the other monkeys would physically prevent any monkey from climbing the stairs. Now, the psychologist shut off the cold water, removed one monkey from the cage, and replaced it with a new one. The new monkey saw the banana and started to climb the stairs. To his surprise and horror, all the other monkeys attacked him. After another attempt and attack, he discovered that if he tried to climb the stairs, he would be assaulted. Next, they removed another of the original 5 monkeys and replaced it with a new one. The newcomer went to the stairs and was attacked. The previous newcomer took part in the punishment with enthusiasm. Likewise, they replaced the 3rd original monkey with a new one, then a 4th, then a 5th. Every time the newest monkey tried to climb the stairs, he was attacked. The monkeys had no idea why they were not permitted to climb the stairs or why they were beating any monkey that tried. After replacing all the original monkeys, none of the remaining monkeys had ever been sprayed with cold water. Nevertheless, no monkey ever again approached the stairs to try for a banana. Why? Because as far as they knew, that's the way it's always been done around here. Okay? So let's keep that in mind. Just because things have been done a certain way doesn't mean that they should be done the same way. So we don't have to talk too much about us. So let's talk about, and I'm not going to go too much. We've had lots of stats, so we're not going to do too much more on stats. But one of the things I uncovered during the crisis, and I learned this from a very interesting discussion with Chip Case. You've probably heard of the Case-Shiller housing study. So Chip Case I was talking to during the crisis, and he said, you know, it's interesting what you do investing in community banks, because a lot of what I do in the Case-Shiller housing study doesn't have much bearing on that. I'm thinking, why? I mean, mortgages, right? That should be relevant. He said, well, there's 2 reasons. One, the Case-Shiller housing study is 20 metropolitan markets, and probably most of your community banks aren't in metropolitan markets. Okay, that made sense. He said the other thing is that 30% of our index is weighted to California. That I didn't know. And he said, in 43 states, median home price to median income hadn't changed in over 20 years. 43 states. It was only 7 states where there was a massive shift. Look at California. And this is a pretty long time cycle, right? We're looking at since 1979. And you can see that California kind of broke a cycle of what the affordability, not the price of a house, median home price to median income. And if you look at, you know, where Arkansas is, pretty benign. You just sort of heard that from the regulators. There really was no bubble here. And from all the banks we've invested in this state, which have been quite a few, we would hear, you know, what bubble? Not here. Well, it's actually proven out. Look at California. In fact, look at the trend now. A little scary again. That's the bubble. I used to draw it as a joke. Now I leave it. That's literally the bubble. So when you think about trends and you're thinking about investing in a bank, part of it is really understanding the underlying market. What's driving the future performance? Now, I can't tell any bank in here what their future will be in the 21st century, but I can talk a few things today about if you don't address a few critical issues, you might not have a bank in the 21st century, because there are some constants to think about. You've heard from FDIC in the last discussion, there were 3 industries that were almost recession-proof and always are: government, healthcare, and education. When you're looking at a community bank, when I look at a community bank, I'm looking at management first, tolerance for risk, alignment to their bank, but the second thing I'm doing is understanding the footprint of that bank. Because if you have a wonderfully capitalized bank, very profitable, outstanding management team, but almost all your customers work at a single auto parts manufacturing plant, there's probably going to be a rough period, right? However, if you look across the country in markets that are either very diversified employment or government, healthcare, and education, they did very, very well during the crisis. Another interesting stat for you, by the way, during the whole crisis, 75% of community banks remained profitable. That's the fun part about lies, damn lies, and statistics. You can really skew them. But just by count, community banks, 75% of the time were profitable all through the crisis. Regional and money center banks, only 45% of the time. Community banks, even though they only represent about 18% of the banking industry's assets, they have about 58% of the nation's small business loans on their balance sheets. That's a massive disproportion. And if you want what we've just been hearing about, you want job growth. Well, job growth tends to come from small and medium-sized businesses, and that's where community banks have always played a role. So thinking about unemployment, thinking about trends, understanding where we are in the cycle. You look at Arkansas, it kind of follows the trends, just less volatile. But that's really where the community banks have always existed. You know that in the 1920s, there were 30,000 banks in the United States, about 1 per 2,200 people. It's about the same as a convenience store ratio. Then you had the FDIC, and you had for a long time somewhere in the 14,000 range until 1970, and it's been slowly working its way down to around 6,500 or so today. 98% of the banks in the country have less than 10 billion in assets, 92% have less than $1 billion. And yet, there are about 5,850 banks that are profitable and well capitalized today with an average ROE of 9.44%. And that whole industry performs like an investment grade credit. You know, if you were to invest in an investment grade bond fund, a mutual fund, you might earn 3%, maybe 4%. These banks are earning 9%. That's pretty good. And they do it with a lot less volatility. So what are the issues that the community banks are going to have to face with? Well, they're tired. Transitions. Average age of a management team at a community bank in their 60s. Average age of a board of director in their 70s. There's a whole transition coming in, including the shareholder base. Because you still have, maybe 500 banks that are publicly traded in this country? The rest are privately held. So you have management, board, and shareholders all are going to have to be transitioned. It's a major issue. We're going to talk about that a little bit. Interest rate risk. I'm not going to belabor this, we've talked about it, but it is one thing that a bank has to be conscious not to be very short-sighted in how it thinks about interest rate risk, because it is a question of when rates move, and there's no right answer. You know, we used to talk about the lost decade in Japan with interest rates. We're now in the third lost decade in Japan with almost zero. So I'm not saying that interest rates won't move, but who knows? Right? There's a lot of issues that contend with that. The third is the regulatory construct. Yeah, we have some very good chat at the St. Louis Fed in DC talking about regulatory relief for community banks, which I do think is needed. It is not a level playing field in terms of the risks these banks take. Sure, a community bank might be more concentrated in its geography, but the risks that it takes as a business model compared to a money center or regional bank are far, far less. There's far less volatility. And so regulating the same way doesn't make sense. But these are, again, challenges to deal with. Expenses. Community banks are about as efficient as they've ever been, but they need to be more efficient. It doesn't mean simply just cutting more heads. It's thinking more intelligently about how to use the personnel that a bank has. An average bank has about 76 employees in this country, average bank. And you think about, okay, if that's what's needed to run that bank, those 76 people can have 3 functions. They can originate new business, they can manage credit, or they can do compliance. Those are really kind of the 3 main functions, right? Bring in business, manage the risk, or report the risk. And the more people we take of the 76, because I think that's kind of a fixed number, really can't afford to add a whole lot more staff at a community bank without really impacting earnings significantly because of that size, then you have to reallocate people. So if I had to choose between a little bit more reporting on QM mortgages or taking the same 1 or 2 people and having them on risk management, I vote for risk management. So it's a question of using the resources wisely, using technology, internal and external, to try to find ways to better manage risk, outsource functions that might not be so efficient to do inside. And the last one is deployment of technology. And Julie touched on this. This is one that I think doesn't get enough thought because it's always put into the context of cybersecurity or disruptive. It doesn't have to be that sexy. It can be pretty basic things. But it's most important to give customers the tools they need to stay with your bank. It may not be in the way of attracting a new customer, but you want to make sure that you're giving a customer the convenience so that they're happy to stay with the bank. And let's talk about a couple of these. So why is succession planning important? Right? What are the 2 constants? Death and taxes. Now, sadly, there's a bit of morbidity to that, but it's not untrue, is there are things that you know will happen, but you don't know when. Those are the known unknowns. And then there's unknown unknowns. A hurricane, a tornado, someone gets hit by a car, things that you can't plan for. And you have to be prepared. So the board of directors is responsible for corporate governance. And yes, we hear the term a going concern as an accounting term, but as an investor in a bank, it's real. I need that bank to continue. It has to have life ongoing besides the CEO or the CFO or the chairman. And so there has to be, and I don't see enough of it, having touched, we have investments we have a deposit business as well in about 800 different banks in all 50 states. And succession planning is not very well done. It's something that we do worry about. So when you think about what a real succession plan is, because if you don't have one, your future might be in question, it's a formally documented process. It's not just a concept, right? Just like a business plan, it should be constantly reviewed, right? And it's something that has to be amended as the personnel, the strategy, and the market change around the bank. So you think about the current business model, the strategic business plan, and these kind of known unknowns, contingencies. Those are the three different paradigms of planning for the future of a bank. And that goes into your succession plan. So when you're layering these together, right, the first is the analysis. What's the vision for the company and what challenges will it face? Because that's going to determine who you want in the bank for the future. Development. Are you grooming internal people or are you planning to source from outside? Which candidates are ready to take on the roles? Because if you go in from someone internal, you're creating a void. And in a small company, and a community bank is a small company, you have to have someone to fill that void. Are you training those people to move up? Because I think for community bankers, finding good talent, is difficult, right? So you need to use what you have. And then transitions. As you're transitioning these people in the first 12 months, how are you handling that process? So things to think about in the context is there's this whole circular plan of constantly analyzing, developing talent, selecting those folks, and then transitioning. And that should be a constant. So as a long-term investor, what are we looking for? Let's take an example, right? A $550 million bank, 66-year-old CEO with a 35-year track record, has disclosed health issues, and is also the chairman and COO, right? Not uncommon for a small bank. That's going to give us some concern. If there's really one person running a lot of jobs, aging, some health issues, and not hearing or seeing some continuity of how they're grooming people to take over, right? That's going to make it very difficult for this bank in this kind of a hypothetical profile to raise new capital, to continue to grow. Right? Not so good. 63-year-old CEO takes his 44-year-old CFO to investor meetings, right? And they share the discussion, they complement one another. That's a very good sign. You're seeing that they're grooming for the future. That's going to give an investor comfort. Right? Third example, bank says, we have a good plan, we have a recruiter we talk to, we know who we're looking for. Well, nothing wrong with external talent, but one of the things, and you've heard a little bit about it from the regulators, is keeping people who are local to that market, right? The lender-borrower relationship, the breakdown of that from Wall Street, which was really guilty for a lot of this. It wasn't so much the banking system that caused this crisis, it was the shadow banking system, a $5 trillion industry of unregulated lending by hedge funds, CLOs, institutional investors, people who basically had no constraints on the leverage, how they did their business, underwriting, passed the hot potato to 16 people before it landed, and something sold to Iceland. Right? That's what caused the crisis. Traditional lending normally doesn't have that issue because if I make a loan to you and we're in the same community, you're not going to be so willing to just walk away because I know who you are. I know where you live. I probably financed your kid's college, your car, right? There's a real connection. That disappears in very, very large banks. And by the way, the top 30 banks have grown since 1980, 22-fold in size. And inflation's gone up 2.6 times. Do you really think that those largest banks can still focus on small customers? No. So just a couple of things right, around succession planning. I know this is very abbreviated, but we're going to cut through a few. Interest rates, the second topic of tired. Look at the blue line. I'm not worried about community banks. Right? Most of them are closely held. It's their money. They're worried about it. But look what the mid-sized banks, mostly public banks striving to be the bigger banks, are doing. Right? That they are basically really reaching for risk. Right? So things to think about is as these interest rates are moving, the volatility and risk to capital is an issue. Bank regulations. Right? Again, you can see the number of community banks and how it's dropped. So what you've had in the regulatory construct is a 44% reduction in consumer financial products, and even smaller banks, right, adding one person can take 23 basis points of return on assets off. That's a massive shift. So the cost of bank regulation is an issue. And you just have an ever-growing universe of a regulatory construct to work with. However, you have had a change in the small bank holding company policy statement this year, which does allow approximately 616 banks that before could not use more Tier 2 capital at their holding company. They can now use tax-deductible Tier 2 capital to create common equity at the underlying bank to a greater extent than they did before. And economically, as you can see, that creates, without really adding much in the way of risk, just being smarter about a capital structure, which is what we do. We invest in banks, and we're interested in investing in any healthy bank in this room. Literally, we have money to invest. And that can really improve the ROE. So using every advantage you can. Right, so outsourcing internal audit, looking for ways to be able to reduce the cost structure of day-to-day routine is definitely something that will help, both on the regulatory side and the expense side. Right, and on the expense side, non-interest expense to total assets since '92 has actually been improving, but the problem is on the flip side, NIM compression, and part of that tying to interest rates, has been offsetting it. So think of that as an ability for more earnings in the future. Right? That's something that actually is there for the benefit once rates normalize, whenever that occurs. So we still think that all of that efficiency that's been sort of built into the system is waiting to be released in earnings once NIM becomes more normalized. And you can see that, right? That the salary expense has gone up, right? But the non-interest expense has actually gone down. And premises really hasn't changed. So if you think about the human capital component, the average institution grew by about 3.4%, right, since '92. But the salary per FTE has increased at about 3.7%, and the total assets per FTE has increased by 3.1. So that side, the human component, if you need to quantify the regulatory compliance side of this, it is quantifiable, right? It's had an effect. So quickly on technology, what I see in technology for community banks is huge. It's not a small thing. Since 1968, with the ATM, only the largest banks could afford to basically have an advantage in technology, right? They were the first to have ATMs, the first to have telephone banking. Press 1 for savings, press 2 for checking. Internet, they were first, right? Mobile banking, they were first. But we are literally right now at a point in time, in 40 years, where community banks can get very inexpensive access to technology, where they can now be first. There's no advantage left for a large bank to put in a mobile payment system or one of those little square credit card readers any faster than a community bank. In fact, now they have the disadvantage of their mass. So I'm pretty excited that for the first time, community banks no longer have this disadvantage. That's a major shift, right? And technology is critical because right now, customers of large banks are dissatisfied with the customer service. And if you need proof of why customers deal with community banks, the average return on assets, yield on earning assets for a community bank is 40 basis points higher than a larger bank. Yet for 25 years, the charge-off rate at smaller banks is about half that of large banks. So it's not that they're taking more risk. It's that the customers don't mind paying a little bit more for real customer service, right? You can quantify that. That's the critical piece. So just in summary, right? Capital. If you're thinking about capital, try to think about it and use every advantage you can. If it's non-cum perpetual preferred stock, rather than giving away the future earnings of your bank, or Tier 2 sub-debt, which is tax deductible. We're making investments in banks now, pre-tax from $699 to $745. That's 4.5% after tax. That's very efficient capital. Right? And think about succession planning, technology so that you keep your advantage, right? And keep fighting that fight, because really the wins are coming in your favor. As much as you don't hear that, I do believe that to be true. And I think it's time for the governor, so I will step off. Thank you very much.